Okay, hi again, everyone. This is Russ Condi. I think we'll go ahead and get started. It's about 2 minutes after. We still have folks coming in. We've actually got a pretty good sized group, and it's great. I mean, I actually see a lot of familiar names coming to these, and a lot of familiar names of folks that I know personally. So I really enjoy doing these when I see it's a list of people that I know keep coming back to these, or people that I know personally. That makes it a lot of fun for me. Um, it's great also. There's a good set of folks on, a good number, and as is pretty typical for these, about half of them are already club benchmarking subscribers, and about half of them are not, which is great. I love that because for the subscribers, it gives almost a little bit of a training session of ways that you should really be thinking about using the data that you can pull out, when you go ahead and run your own charts and reports. And obviously for the folks that aren't members, it gives them some great information to walk away with. If they end up joining down the road, that's great. But either way, I think it's a win-win for everybody that attends. So we'll go ahead and get started. Today's specific webinar, we're continuing down the series of looking into this executive dashboard. We launched this concept in Notion, I guess it was back in April, and what it really was boiling up to the surface. What we found over 5 years of doing this seemed to be the indicators that, frankly, if you had to really watch the ship and we're steering the ship with the right measurements, what are the indicators that you would use? And it turns out there's about 14 or 15 of them that we found, seem to be really important across the entire range of clubs. Doesn't matter what kind of club you are, or where your club is, or how big it is, or any of those sort of things. And it is a very business-like approach to looking at a club, which frankly I think has been missing a little bit in the industry for an awful long time. So we're going to look at membership KPIs today. The prior sessions dealt with a little bit more of the meaty part of the finances. Obviously, it all boils from membership dues, so these are critical. But it looked at things like the gross margin and net operating income, and some of the operational KPIs like payroll ratios and food and beverage ratios, and certainly critically some of the capital information, capital income, and then what we call net available capital and capital ratios. So those are critically important. So if you weren't participating in those, or you haven't gone in and watched those videos, we archived all these on our website. And so you can go back and look at them anytime. But I would strongly encourage you, whether you're a subscriber or not, certainly if you're a subscriber, almost even more, because I think it really is, in a way, those sessions are great training sessions on how you should be educating your board through the use of those executive dashboard reports, where they're using the Word version or the PowerPoint version. So I think it's been pretty pivotal now when we're certainly working in boardrooms with clubs, and we start having a discussion centered around this executive dashboard report. It changes the discussion because first of all, you're dealing with standardized data, and you're dealing with business terms that they understand and grasp. So it really can have a pretty big impact. I'm just going to take 15 seconds on this slide. As folks know, I use this as just a little bit of a positioning slide for these webinars. It's just a framing of the industry. It's a big industry, but it's very fractured in that there are 4,000 or 5,000 different clubs across this industry, and frankly, every one of them has run as their own little mini fiefdom, without a lot of standardization around. And I think that's really what we've brought to the industry is a level of standardization of measure and of model, and which I think are both critical and useful. So I think that's had a big impact. And this is we're probably all here for generally the same reasons. We're either board members, and we're the right kind of board members because we're intellectually curious and we want to learn about clubs, or we're on the other side of the fence, and we have to deal with making sure that frankly, our boards are as educated they can be about their own club and about the industry, so that when they're tasked with the governance role that they have, that they're actually adding value. They're not either neutral to the club or subtracting value to the club, which unfortunately happens a lot in this industry. So this is all about creating that standardization, and I still do have a dream, and I think it might happen where you get a couple GMs or board members and they bump into each other, and they actually have a discussion about each other's gross margins, and it's meaningful because it's standardized, and they can talk about what it means and the impact of it. So, I think I'm going to see it in the relatively near future. So I feel pretty good about that. So if we look at what we're going to do today, today's goals really, we're going to review the 3 membership KPIs that are in the executive dashboard. They're I would sort of say less complex than some of the other ones because one of them, annual dues, isn't really a calculated KPI. It's just your number. But when we look at these 3 things together, they tell us an awful lot about the club's ability to finance and support itself operationally. So we'll take a look at them. We'll explain why they matter. We'll do, we won't just look at the numbers, but we're going to do some color commentary around the numbers. And I think, frankly, that's what makes all these numbers interesting is the commentary around it and how you frame it and put those numbers in context. And ultimately, this is all about, being proactive and not reacting, right? Not talking about dues only because the club is under stress because the dues revenue is too weak, but actually understanding the importance of it, both in the management suite and in the boardroom, so that proactively you can start to look ahead and say, is our dues philosophy on track to support, the dues engine that we need coming down the road, and in terms of dues increases or how we measure it, all things like that. This to take a second, this overall dashboard, I've sort of talked about it already, but ultimately it is about presenting the right standardized data to keep the board strategic and to keep them on the right level and to keep them out of talking about things like food costs and that kind of stuff, which really doesn't add any value. So it's reflective, but it's also forward looking, and ideally all these measures, executive dashboard, everything we look at, ultimately as we embrace them, internalize them, it's about identifying industry standards that are predictive of performance. So you don't just use these looking backwards, but you use these looking forward. So, dues ratios and gross margins. And in the next session we do next month, we're actually going to talk about budgeting. In a new budget section, we, actually, I just realized, thank you for someone sending me a comment. I hadn't clicked my share screen. So, or my, no, I had shared it. Share your screen. Yeah, I think it was sharing. Someone doesn't see the slides, so they're not advancing. I hope other folks can see the slides now. I'm on the 4th or 5th slide. So maybe that person is just having an internet problem. So, it's about making things predictive of performance so that you can go and actually enter some basic budget information into the platform and then run your KPIs in a forward-looking way and literally say, if I'm hitting my current forecast or I'm hitting my budget, that this is going to be the result of my KPIs going forward. So, that's a big deal when you can look at these on a forward-looking basis, not just on a reflective basis. Okay. It's all about, changing and unifying the dialogue. We all know the crazy, discussions and thoughts that happen. So we don't have to spend too much time on that, but that really is ultimately what all this is about, is moving the knowledge and education through the management chain of the club and then eventually into the boardroom of the club. So in this executive dashboard, we all know, if you've looked at it, it's got 5 sections, and we're just going to look at this one section today, membership. We've looked at this three other sections in prior webinars in the last few months. And specifically what we're going to look at are the dues rates and member counts. And the reason we sort of have these listed as one KPI is that, it's really together. The dues rate and the number of members you have is really, you'll see this concept of the dues engine I'm going to talk about here in a minute. It really is about that dues engine. And then we're going to talk about member attrition, not to the extent we are about dues, but I think there are some interesting perspectives to have on clubs that have high attrition and clubs that have lower attrition. And we can look at some of the attributes of the high attrition and the low attrition clubs. So I think that'll be interesting. So, we literally do use this concept of the dues engine, and because I think it applies. You think about it, you've got a 2-cylinder engine, number of members and dues per member. And ultimately, what you're trying to strike in every club, it's different in each club per se, to some degree. But, what's the right balance between the number of members that the club wants, membership wants, and the dues that each member is, capable or willing to pay. And it's that balance that gives you ultimately the dues revenue that we know drives the finances of the entire club. We'll measure that specifically in a minute. But ultimately, it's about that right optimization. We all know the clubs that had a particular level of members and dues, and maybe in bad times or the club fell on troubled times and they start losing members and they start jacking up the dues to a rate that frankly isn't really commensurate with the culture and philosophy of the club, and you can never quite balance the books on that. So that's an engine that gets out of balance. Now, there are some clubs that have very few members and very high dues, right? That's your kind of exclusive clubs, and that's their philosophy and context. So that's okay. That's the balance for them. And there are clubs that have, lots of members, 3 times the normal, 1,500 members, and each member's paying $3,500, and the place is just a cauldron of activity, and that's the kind of club that they want. So, the balance looks different for each clubs, but you have to know sort of where you're shooting for and targeting that right balance. If we look at, how do you measure the dues engine? And we use a very simple ratio we call the dues ratio, and it's simply what's my total dues revenue divided by the operating revenue of the club. And it turns out in the industry, it's a little different on different parts, but in the golf side of the industry, it's basically right at 50% at the median. Now you can see there is variation, right? But half the clubs fall between 42 and 55%. And frankly, the higher the dues ratio, generally, the better the results, operating financial results of the club, because obviously dues is the best kind of revenue you can get, right? There's no cost associated with dues like there is with food and beverage. So, if 55 or 60 cents of every dollar coming in has no cost versus only 42 cents of every dollar coming in having no cost, clearly this club is going to have the opportunity to have physically more cash that they can use. By the way, they'll ultimately have a higher gross margin, and they'll be able to fund more things more effectively in the club. And if you look, if we break down, what are the attributes of clubs that fall into these different groupings, right? This lower quartile, these middle 2 quartiles, and the upper quartile, we can see if you have a weak dues engine measured by the dues ratio, you have a set of attributes, and your attributes tend to look like you have a lower gross margin than other clubs in the median at large. You tend to have a lower member count, probably not too surprising. Your membership probably isn't quite full. And actually the dues is pretty much a typical dues. But what's interesting, as you see the dues ratio go up, you'll see the the gross margin of the club move up to more of a median typical number of 59%. 60% is the gross margin for the industry. Interestingly, the dues is the same. They just have more members. So what moves their dues engine up the power scale, if you will, isn't that they're charging more for dues. They just have more members, and they've got a considerable number more members. And then interestingly, as you go to the next quartile, this upper quartile, the folks that have dues ratio above 60%, let's say, obviously their gross margin is reflective of that. But what is interesting, I just pulled these numbers today, and I thought this was interesting. Their member count is not any higher in this quartile to this quartile, but they're getting a lot more per member in dues. So I just found it interesting that to move from this quartile to these quartiles was the same dues but more members, and then going from this grouping to this grouping was the same number of members but more dues. I just thought that was interesting, and I may dig into that a little bit more because I think there's something around that might be worth delving into. By the way, measuring that dues engine, there is a different median value for dues engines depending on the kind of club you are, and I just thought I'd reflect that. Generally, it's 50% for clubs with golf and about 40% for clubs without golf. But in case there are some city or yacht clubs, I didn't want you to feel like you were in trouble right off the bat by thinking you were 10 points low on your dues engine. I think the real telling perspective though is when you look at where the gross profit comes from. And what you really see is that these are pie charts of where the gross profit comes from for the different kinds of clubs. And I'm not going to go through each one of them, but the obvious message is that the vast majority of gross profit comes from dues. And so obviously by definition, if your dues is weak, your gross profit's going to be weak, and gross profit is what you use to fund all the fixed expenses of the club. So, without that dues engine, you're really starting on a tough foot. And if the board if you have a dues engine issue and the board is focused on other things like food and beverage, you got to use every piece of data you can get from us. We're happy to help you, but you got to get them off of things like food and beverage and back onto dues. It's a harder problem to solve, right? Getting more members is harder to solve than getting the next banquet, but one fixes the problem and one doesn't. So, when we look at the two individual measurements of number of full member equivalents, and that's how we normalize member counts. We just take the total dues revenue and divide by what a full member pays, and that gives us full member equivalents. And that's how we can normalize, your social members and things like that into that number. We're not going to look at the specific values here, but I will say a little bit in more detail of what I talked about earlier. It's pretty typical that we'll see clubs that fall into different buckets, and pretty easily we can it tells a story about the club. Here's a club that has for its size, right? Because usually when we're looking at this, we do a filter based on the club's revenue, plus or minus a couple $1 million around their revenue number, and or maybe plus or minus 10% is a better way to think about it. So they have a little bit low number of members, and they're a higher dues level. And what we see is they're burning cash significantly. So when we see those three things, we pretty consistently know what's going on, right? Here's a club that lost a bunch of members. They've been trying to move the dues level up for the members they have left. And the result is, of course, they can never quite balance the books on that dwindling member count. So you end up with an operational deficit, which ends up stealing from your capital. And so therefore you can't invest back in the club. And that's kind of how the spiral for clubs looks, right? That's one of the ways you see that go down that path, and they price themselves out of the market, and they're really almost, because they think they have to, and they're almost hurting their ability to get new members. It's a very challenging place to be. I'm not saying it's easy to get out of, but you do want to know you're there. If you don't know you're there, you have a much lower chance to get out of it. The flip side bucket is a higher number of full member equivalents, paying less dues than is typical, right? This is a real club, and I know the club, and if you walk through the door and you saw the amenities and the energy and what those members have to utilize in the club, you'd be amazed at what they're getting for $4,300 a year. But they have a lot of members, and the net of all those members paying lower dues is they throw off an operational surplus. So that's that kind of healthy, vibrant club with a lot of buzz. Doesn't mean you have to be in one. There's nothing wrong with being, right in the middle in terms of member count, right in the middle in terms of dues, and right in the middle in terms of net operating income, which is essentially break even. That's a great place to be too, and that's clearly a sustainable place to be. But it's the balance of those three things: how many members I have, how much are they paying, and are they supporting, and is that dues revenue supporting the club enough such that I'm ending up with an operational break even at best? That's kind of the strategic way to think about the dues engine of a club. I talked a little bit about this, but this is just a little table that reflects, is your member count high, low, or typical? Is your dues high, low, or typical? Is your operating result, break even, positive, or negative? And we call it kind of a value proposition indicator. Depending on where you are in this combination of things, you're either sort of imbalanced, you're really balanced plus, really vibrant, high value proposition club, or you're struggling. Maybe the value proposition isn't as apparent, and the club frankly needs a facelift, and it's a challenge of how to get there. And then honestly, you have the clubs that have few members, high dues, their operational result is good, and they're the small exclusive clubs. But knowing where you fit in these three buckets is kind of an interesting way to think about your club. And then you think about, do we really have a visible value proposition? I mean, that's a big question, right? But there is sort of a little way to measure it here. Ultimately, it is focus on dues revenue. And, I like the phrase, you can't cook your way out of a weak dues engine. Unfortunately, way too many clubs at the board level try to do just that. And it's a red herring. You all know, if you're on this call and you've heard me do webinars, or you've heard us, present at any place, our position of food and beverage, which is it's a critical amenity, but that's what it is. It's an amenity, no different than a tennis court or a swimming pool, except everybody tends to use it. And so, you really have to, if the issue is a dues engine issue, focus on the dues engine issue, right? Don't just detract by trying to, patch up a bad dues engine. I mean, I've seen clubs where they're in real dire straits and they turn into a banquet factory for a short period of time, knowing that it's a tactical way to impact the strategic problem they have. That's okay. I mean, that's fine. If you have to do what you have to do, you got to pay the bills, but it's not a long-term solution. It's a band-aid, and it does come with impact on the overall membership, of course. I thought it was interesting. I did take a look. Obviously, we're in 2015, so we don't have the full year data. But I did look at the last 2 full years we had in a row, and I said, well, let's see what's actually happened. And these are all clubs that had data, complete data for both years. So we're not mixing different clubs in here. So what we found was at the median, clubs had increased their full member dues. This is the amount that a full member actually pays to be a member on the median by about 3.9%, which is a pretty healthy increase. The number of full member equivalents that the clubs had was up by just about a percentage point. And then the overall, the net impact on their dues engine was their dues revenue had gone up by about 3.3% year over year. Those are pretty consistent numbers that we tend to see year over year now that we've been doing this multiple years. The 3.9 is a little high. What's pretty typical we see is clubs raising their dues about 2 to 3% annually. I'm going to talk about it in a minute, but I'm a huge believer in training the membership that dues goes up every single year. Right? Costs go up every year without fail. We know they do, and we need to deliver the same value and service that you're getting every year. So dues is going to go up every year. It might be 1% one year, it might be 3% one year. Now that can also be adjusted based on the number of new members that you bring in, right? If you bring in a bunch of new members that are bringing, initiation fees and dues along with them, you might not have to increase the current member dues so much. But if you're kind of steady state, you really need to think about a dues increase every year, because frankly, your dues revenue needs to go up every year, because as we know, that's the engine that funds the entire club. And if your costs are going up, you have to prime that engine a little more as well. So, that 2 to 3% is a good number to use, and it's a number that we see quite a bit. Kind of in line with that, I like this, and it makes me want to pull my hair out, whenever I hear clubs doing this, and I know everyone does it, so I know, I get it. But the most dangerous question clubs ask each other every day is, hey, what are your dues, right? How much are your dues? And hopefully now that we've talked about the dues engine a little bit, it puts it in perspective, because you kind of realize that when all you have is that dues number, oh, ours is 7,000, ours is 7,400, ours is 5,800, ours is 12,000, right? That number alone doesn't tell you anything, because what they have a particular amount of dues revenue they need to generate to support their club, right? Their dues engine is their dues engine, and it has to output whatever it needs to fund the club. Your dues engine is your dues engine, and you need whatever you need to fund the club. And what they charge for dues and you charge for dues has nothing to do ultimately with either what your dues engine generates or how much what you need your dues engine to generate. So, it's really a bad idea. And I know this is something that comes in the boardrooms a lot. Now, if you're local clubs, right, and you think members are looking at my club and this club and that club, from a marketing perspective, I get it, right? That there's marketing information to be gleaned from, hey, what are they looking for dues and initiation fee versus what we are? Because they have to judge the value proposition of our club based on what we deliver and how much it costs to be a member. That's marketing and membership, strategy information. But it's not, asking what someone else's dues is not a strategic question that helps you figure out, are you charging the right amount to fund your club? Because that you have to ask, you got to come from the top down, right? How much dues revenue do we need? What is our dues engine? That 50% number is a great starting point. May not be where you need to be, but it's probably going to be pretty darn close. And then what's our balance of number of members and how much they're paying? That's the way to approach that. And so, I really implore folks to try to get away from this and educate whoever you need to inside the clubs of why that's a bad question to ask because when you ask it and you get numbers back that are different from your numbers, you start to rationalize thinking that your number's wrong, clearly, because everyone else has a different number. So you either think that your number's too high or your number's too low. But obviously, I've gone through where that's not the case. You can't come to that conclusion. So I've spent a little time on here, but it really is important. So, in terms of dues engine maintenance, let me just do a time check here. So, okay, we're doing pretty well. There are some things that we tend to hear a lot, right? We hear them a lot in club benchmarking because we're talking to, many, multiple clubs every day. And you can see it. A club joins and you run their reports and you see a dues engine that's, 41%. And I know the answer, but I have to ask the question, hey, when's the last time you had a dues increase? Oh, we haven't increased that in 5 years. Well, I can tell because, your dues engine is 40%, your gross margin is 10 points low and you're burning cash. That's what happens when you don't increase the dues, and that money's never coming back. And now in one shot, there's been a few clubs that have done it, to their credit. But it's very hard to say, okay, guess what? We've been remiss. We have to increase our dues by 10, 15, 20% in one shot. That's pretty hard to do. So you got to stay ahead of that curve to the extent you can, and otherwise you just fall further and further behind. And then then people are unhappy at the club because you're not funding the club. So then they really don't want a dues increase because they feel like the club's going downhill. So boy, you got to stay ahead of it. They can't agree to raise it. It's because they don't understand the role of dues on gross margin and the role of gross margin on the operating bottom line of the club. That's what this executive dashboard is all about. Is showing them the important indicators and creating the links between them so that you can manage the knobs you need to, right? Like payroll ratio, like dues, things like that. To get the results you need. The not on my watch president, we're not having a dues increase on my watch, man. I tell you what, if that person understood what they were doing to the club with that kind of thought process, frankly, it couldn't be farther from the notion of fiduciary responsibility. He or she thinks they're doing the right thing, but they clearly don't understand the club financial model, and there's an opportunity there for sure. And we're full, but we're still short on cash. So that's something we hear, and it's a sign that frankly you haven't had your dues engine keep pace. So when I think about we kill this metaphor of a dues engine, but I think it's easy to grasp. Everybody gets it, right? It's a couple cylinders and something's coming out the other end. But understanding your key ratios. We've talked in this one about the dues ratio. We've talked about the looking in concert, number of members, what each member pays, what's my operational result, ties to the gross margin. These things all tie together, right? They're not independent numbers. To the extent you can, this is a process, not an event, but train the membership to expect a dues increase every year. It's a lot easier discussion and sort of battle to have every year if it's are we going to have a dues increase this year? Which today is perceived in those kind of clubs, it's perceived as, oh, geez, what happened? We have to have a dues increase, right? So it's a view of failure. It's not a failure. Dues increase is part of being a club. It's part of being a member of a club. If you don't have a dues increase because you failed as a management team or failed as a board, to the extent it's almost the other way. If you don't have a dues increase, I would say you've failed as a board, probably just to some extent. So train them to expect it every year, because then it's, hey, I wonder if it's going to be 1% or 3% this year, right? That's a much better discussion to have. Obviously, you want to use standardized, reliable data. For the folks on here that are members, if you're not using club benchmarking for this kind of stuff, start using it, and we'll help you. If you haven't had your review session in a while, we have a scheduling tool. You can go on and schedule your review session. We'll take you through this stuff if you need a refresher course, no problem. But it's in there, and that executive dashboard report is a great way to start. And there's a bunch of definitions in that one report around all the KPIs. And don't treat your capital income as a patch for dues revenue. That's a bad idea. Stealing your capital because hey, we got a bunch of initiation fees this year, so let's keep the dues low and steal that money. I think that's a philosophically slippery slope. I'm not saying tactically it might not be okay one year, but it's philosophically slippery, and I think it's a bad place to go. So And then, we did just, this is going to be a quick one, but the other metric in the membership part of the executive dashboard report is turnover ratio. Full member, what we call full member turnover percentage. Obviously, it's an important number. For any member-derived organization, turnover is probably, one of the more important measures they need to understand and to mitigate their turnover. When you think about it, clubs that have a 10 or 12, 12%, we see clubs, you see it very high. Some clubs have a 12.5% turnover ratio. Well, think about it. If you have a 12.5% turnover ratio, you have to turn over the entire membership of the club in only 8 years. That's almost impossible. So, a club can't survive with an ongoing steady state turnover ratio that's very high. And the median of the industry is about 5 or 6%. And there's all kinds of ways that attrition happens. Deaths, moves, people are unhappy, economic issues, whatever it might be. But obviously, lower is better. And what is interesting is if you look at the attributes of clubs that have high turnover versus low turnover, the low turnover clubs tend to have higher initiation fees, right? 42,000 at the median, higher member count that is typical, 550, 600 members, which is above the industry median. And they're a little bit bigger clubs, right? The average club is around $7 million. These are on average around 8. So, half are above 8, half are below 8, let's say. If we flip to the other end of the spectrum, the high turnover ratio clubs, you see their initiation fees are low. There's $7,000. Member counts are a couple hundred members less, and they tend to be smaller clubs. On median, these are $4.5 million clubs, which means half of the clubs are smaller than $4.5 million and half are larger than $4.5 million. And so it's interesting. I guess it's intuitively not that surprising. I mean, initiation fee, there's a little bit of a chicken and the egg, right, that comes into place here. Is the initiation fee low because the turnover ratio is high and they have to try to drive in lots more members because they're losing them really fast? Or is the initiation fee, is the turnover ratio high because these members are joining and there's not a lot of skin in the game? So if they're in for 2 or 3 years and, there's a little blip in the road, they say, I'm out of here. Whereas, if you plunk down 40, 50, 60K, obviously some clubs even much, much higher, there's a little inertia that says, well, hey, I got all this investment I put to being in here. I'm not going to leave. I want this place to be a good club that I keep coming back to. So, there is a little cause and effect that could be studied here. But I think it is interesting, just from an attribute perspective, that these are the smaller clubs with lower initiation fees, and some of these clubs are the ones that have $1,000, $2,000, $3,000 initiation fees. That I think is a club that there is, when that member joins, there's really no skin in the game, right? They're going to leave at the drop of a hat if they're unhappy, and because there's just no investment that's keeping them there. So I think that's pretty interesting. So that does, I actually probably should have had a little conclusion or summary slide here, but I'll just sum up. I think I did it during the session, but obviously the dues engine is one of the most critical things. I would say dues engine and capital engine together, right, are probably the two most critical things that correlate to the bottom line health of the club. If your dues revenue is weak, your gross margin is going to be weak. If your gross margin is going to be weak, you're going to have an operating deficit, and you're not going to be able to fund the things. You're going to have problems funding payroll, and it's going to start trickling through everything else. So you got to focus on that. Focus on it like a laser beam, not on, if the discussion in the boardroom is around food and beverage and when's the next banquet, use this information to get them focused on not where the next banquet's coming from, but hey, where are the next 5 members coming from, right? That's where we got to get. And so that's ultimately critical. There is a chat box here. Obviously, we're happy to answer any questions you might see. I don't think I've seen any come in yet, but there's a chat box on the side of your screen if you have any questions. I also wanted to mention the next webinar, before folks leave, the next webinar is going to be on budgeting and forecasting, which the time of the year is right for about that. And I also wanted to mention that for the members on the webinar, we're going to be launching on the platform a budgeting and forecasting section, which basically, by taking in a relatively small amount of data, 15, 20 data points that come out of your budgeting or forecasting process, you're going to be able to generate all the executive dashboard KPIs looking forward. So if you're setting your budget now, once you get a little bit of budget work done, we're gonna be making an announcement, or we're gonna be turning that section on here in the next couple of weeks. But you can enter that data and then run a special budgetary and forecasting executive dashboard report. And then you might get 6 months into your budget, and everybody likes to do current view forecasts. You just update your numbers based on what you think that forecast looks like mid-year or wherever you are in the year, and you run it again, and you say, okay, this is where, real time, this is what we think, this is how we think we're going to end the year, not just from a whole bunch of numbers on a spreadsheet, but from these standardized, KPIs that we know correlate to the financial health of the club. So that's something that's going to get turned on. We'll talk to people about a little bit more as we get closer. With that, I just wanted to see if there's any give Terry a second, or give folks a second to see if
Russ,
there's any
Ari does
questions.
have a question.
Okay.
Asking about the correlation between annual dues and turnover.
Yeah, that's a good question. I didn't. I should have probably. Oh, okay. Go ahead. So what's the question? I did have it in. Oh no, I didn't have it in here. Yeah, in terms of dues levels, I'm surprised I didn't put dues level in here too. I tell you what, Ari, if you can send me an email at rcondi@clubbenchmarking.com, and then what I'll do is I'll add that data into this chart, and I'll just shoot that chart over to you. That's something I should have added, but maybe we'll catch up with that on the next one. Any other questions at this point, Terry? Okay, sounds like not. So with that,
I don't see any.
Okay, I really appreciate everybody coming in today and staying for the duration. As always, I ran a little bit over, but that's kind of my reputation now. And we will see you all in the future on webinars or in person. Thank you.